Okay, now let's discuss the two other types of insurance that we have, and those are property and casualty insurance. Now, property insurance helps you protect your own property from fire or theft or flooding. And when I say protect it from fire, it doesn't mean that it's like a fire extinguisher. It's just that God forbid if the fire happens, then the insurance company will pay you for it. Or if there is a theft or if there is flooding, then the insurance company will pay you for it. Casualty insurance is for others that might be hurt or damaged, so injuries or damages that you as the policy holder might do by mistake, right? And think about it in terms of a car insurance. So if you have an accident, your car is your property, and that is protected in terms of its value by the insurance company. They will pay you an equal amount or whatever is the insured amount. And if you hit somebody else's car, then they will pay them as well. That is casualty insurance. Now, as we discussed in life insurance in the previous video, that you pay premiums over a long time and the premiums don't change. If it is whole life, you pay it for your whole life. If it is term life, then you pay until the term ends. But property and casualty insurance is renewed every year. And if, for example, you're a bad driver, so the premiums will increase for you. If you're a good driver, they can be reduced as well, right? So this is something that is variable, whereas life insurance premiums are fixed over the life. Now, what are the risks to property and casualty insurance? They can be divided into two categories. Number one, how predictable is the payout? So, for instance, if you are talking about car insurance, that you're working in an insurance company which is mostly focused on auto, which is car insurance, you might be able to actually have a decent or a reasonably well ability to predict based on historical data, because not everybody has accidents, right? So, and not only does everybody not have accidents, the claims are independent, because if driver A is having an accident, that has nothing to do with driver B, right? It doesn't increase the probability of driver B having an accident. So that is a good thing. We can actually, to a high degree of confidence, predict these claims. But then there is also this tail end risk, catastrophic risk, which of course the probability of happening is very low, but the impact is huge, such as a hurricane or an earthquake. Because if it happens, many claims are going to come in at the same time, right? Everybody in that area is most likely going to be impacted. So these claims are not independent, right? They are related to each other, they are linked. So what should we do for these type of risks? And as you might remember that when we have risks which are having a very big impact, it's better to transfer them. So what we will do is we will maybe transfer them to a reinsurance, and we'll talk about that later. But first, let's talk a little bit more about these catastrophic risks, that these are all or nothing risks. That means either it happens or it doesn't happen, right? So if it happens, it's obviously going to be a big problem, and we need to predict the probability of these kind of events happening. And how insurance companies do it is they use models produced by specialists. And how do they protect against themselves? So what we do is something called reinsurance, where we would transfer this risk to another insurance company through something called cat bonds, which is catastrophe bonds, and these are derivatives naturally linked to such an event occurring. Now, what happens is that you, as a property and casualty insurance company, can issue these cat bonds, and to attract investors, you will have to offer a higher interest rate compared to other bonds. And if this catastrophic event occurs, which is of course going to be mentioned in the indenture, which is the contractual document between the investor and the issuer, such as a earthquake or a hurricane, then the obligation to either pay the interest or the principal altogether can be either deferred or completely waived. Now, you must be thinking, why would any investor invest in these cat bonds? Well, number one, because they offer a higher interest rate. And number two, the risk that they have is uncorrelated with other risks in their portfolio, such as default risk or credit risk or maybe market risk. So, it provides them a diversification benefit. That's why investors wouldn't mind putting some cat bonds in their portfolio. Now, coming to the analysis of insurance companies, the first thing is obviously the premiums that you get and the payouts that you pay. This is the core business. So let's say if you have received $100 of worth of premium and you've paid $70 in claims, then your loss ratio, which is the first and most important ratio in any insurance business, is going to be 70% because you got 100 and you paid out 70. Think of this like the sales and cost of goods sold scenario. Now, naturally, you will have selling, general, and administrative expenses like any business has. So, here you have your selling expenses and your other expenses related to determining the validity of a claim, where you go and your officers go and they verify that this is a genuine claim. So, that as a percentage of your premiums is mentioned as the expense ratio. So if you add those two, the expenses that you're incurring and the payouts that you're having, you have your combined ratio, that from premiums of $100, you've actually so far earned only $4. But you also have to pay your investors, right? That's where the dividends come in. So after you pay the investors, now you're only left with $3, or the combined ratio after dividend goes up to 97. But then here's a relief, that since you're receiving all these premiums at the start of the year and then all these payouts and expenses are happening during the year and towards the end of the year, so what you do is you invest this money in interest bearing securities, and that obviously leads to some investment income. So you add that back. So eventually your operating ratio is 95, which means that 5%, or if you had a revenue or premiums of 100 minus 95 is going to give you $5 is what you have earned in the business, right? So the combined ratio after dividends is what you do here is that you take your loss ratio, you take your expense ratio, and that gives you your combined ratio, and then you further adjust it for the dividends that you have paid, and this is the combined ratio after dividends. And then afterwards you adjust the interest income as discussed, since the companies receive the premiums at the start of the year and the payouts happen later, so you earn interest, and that interest here in this example is 2%, so you're left with 95% operating ratio, or 5% will be your net margin. Now let's move on to health insurance. So we've already discussed life, we've discussed property and casualty. Now we're going to talk about health. Now health, as most of you of course must be even having, and many of you will be knowing, is for your health benefits, right? So God forbid there is something medically wrong that happens, and then you have to go to the doctor and you don't have money for it. But if you have health insurance, then you can use that to make the payment. But then naturally you have to have been making the premiums payments all along. Now, how and when do the premiums increase? First of all, is this like an annual thing, or is this like a fixed thing like life insurance? So in life insurance, we saw that the premiums remain constant even if your health worsens. So like, let's say for example, I have a life insurance, and when I got the life insurance, I was younger. So my premiums had been calculated based on whatever my health situation was then. Now, if I am older and my health situation has worsened, have my premiums changed? No. Right, so that is a good thing with life insurance, that if you get it early in your life and you get a decent premium, then you just keep paying that premium and you have your life insurance. With property and casualty, unfortunately, as we discussed, the premiums may increase. So if you're getting auto insurance, which comes under this category, and your driving is bad, then every year they're going to increase the amount of premium you have to pay, or they can even decrease it if your driving is good. So that works both ways. Now, what happens in health So the health premiums can increase, right? If the sector costs, like for example, the cost of healthcare in general, the hospital fees, the pharmaceutical medicine expenses, if they're going up, if there's inflation, then okay, the premiums can be increased. But the premiums cannot be increased if the health is of the policyholder is deteriorating. So this is a very, very interesting point.